Good day, fellow investors. Last week I discussed potential stock market crash and why you shouldn't fear it from an economic perspective. We discussed COVID impacts, stimulus impacts, interest rates, valuation, and then I mentioned that what we have to fear is an investment tragedy over the long term. And I thank you for more than 40,000 views, and I welcome all the new subscribers here. So thank you for liking, subscribing, and watching the video. And in this video I really want to explain why a crash is good and how to avoid that investment tragedy in the form of low long-term or zero or negative long-term returns. So last video was about the market. Today will be more about the specifics, and I'll even give you 4 strategies to think about on how getting to your financial goals, because that's the key when it comes to investing. Let's start. Okay, so I said don't fear a crash because a crash is good for you, and we have seen a crash recently and it's already passed. Those that bought here, and I think I made a good transaction, I think it was the 22nd of March, and that is actually, this purchase here is of course the best return that I will have for this year because I bought in a crash. So always welcome crashes. If we look at it a historical perspective, we had 1987 34% crash, exactly like this crash now, 49, 57%, 2000, 2009, and then always the stock market rebounded to even higher highs. So always take advantage of a crash, don't fear crashes. 400% is the S&P 500 up now since 2009, 100% 2001 to 2007, 106% from 96 to 2000. So always take advantage of crashes, and we are already more than 50% up from the March 23 bottom. So a crash is not a tragedy. What you have to fear is an investment tragedy. And the biggest investment tragedy that I could think of is not reaching your financial goals. So we all invest for somebody, someone invests for financial independence, someone for retirement, someone for college for kids, someone for a second house, whatever. So that long-term investing, you can do it safely and surely so that whatever happens in the market, your neighbor gets richer, okay, but you want to hit the target for sure. And a tragedy is not hitting the target for sure, and this current environment makes it difficult but still possible to hit the target whatever happens. Let me explain how to avoid that possible investment strategy. As I said, the first reason why stocks are expensive and why there could be an investment strategy is that over the last 5 years the S&P 500 is up 71%, which means that everything you buy now to reach your goals is 71% more expensive than it was, let's say, 5 years ago. This is already a tragedy because if you add money to your account, you have to add 70% more for the same return, business return. And this is what usually also happens. This is something we have to avoid. Over the last 20 years, the S&P 500 did good, 6%, that's good. Everybody's now talking about 20, 50, 100%. I want to double my money quickly, but this is good. This is reaching your financial goals, and this is what you have to avoid, what the average investor does, which means we have to avoid doing what average investors do and doing the things that surely and safely lead us to our investment goals. You might be thinking, what's this guy talking about? 3%, 6%, 2%. Well, I'll try to explain here. We have a goal, let's say we have an investment life cycle of 40 years and we invest 1,000 per month. If you invest 1,000 per month, 12,000 per year with a 6.3% return, which is the historical average return based on fundamentals, which we'll discuss in a moment, you get to 1 million after 29 years when that compounds. So that is a big difference when compared if you get 3.1% to get to 1 million by investing 12,000 per year, you need 41 years. So the difference is $1.2 million over 40 years, same invested amount with 3.1% and 6.3%. For me, 3.1 would be an investment tragedy, which is what the average investor reaches, and that's why I cannot stress enough the importance of what we are talking here. The difference between this and this in your lifetime, and you make the decisions now that will lead to this difference, is a decade of adding money. It's 120,000 of your money added constantly, or 1.2 million. That's a huge difference. Just another example of how expensive this market has become. Apple, I don't see a difference between Apple now and Apple in 2016. I was long Apple then a little bit, but the change is 315%. So the price now is what the price was in 2015-16 before the split. This means that those buying Apple for the dividend, for the earnings, for everything, on equal earnings are now paying 315% higher price than it was the case 4 or 5 years ago. This makes investing very, very difficult. Consequently, the current dividend yield is 1.77%, and dividends make your long-term investment returns. And over the last years, we have seen low returns, low dividend yields, unlike it was the case where dividend went to 7% in 1982, 5%. These are still good dividends, a little bit overvalued from a historical perspective, but this is really, really expensive. So just small dividends will not lead you to your goals like higher dividends would do easier and faster. Also, an issue is high valuations. Those lead to low returns. We are not yet at the price to earnings ratio that was in the 1990s with the dot-com bubble, but we are getting closer and closer. Don't take into account this peak in valuations now for COVID crisis. I prefer to look at valuations without impact. This was the tax impact, but we are here around 1820, still lower than 24 at the peak of the dot-com bubble, but high from a historical perspective. 25-year average is 16, we are now closer to 20, so expect lower returns. And you can see here that on the forward PE, 5-year annualized returns on average on a price earnings ratio of 20 something are on the lower end and tend towards the negative. When you have low price earnings ratio, returns are much higher, even go to 20% per year. This is investing, and this high valuations can lead to negative returns, which means you don't reach your goals, which is an investment tragedy in my eyes. If I don't look at the price earnings ratio, but at the cyclically adjusted price earnings ratio that takes into account 10 years of earnings, so it eliminates the impact of cycles, which are normal in economies and business, it's even worse. 31.86 is the Shiller price earnings ratio. The average is around 15, 16, so we can expect half the average return from investing over the long term. Also, when it came to long-term investment, 10 to 15 year investment returns, when the CAPE ratio is above 30, best case scenario you can expect 4 or 5%, but you can also expect very bad returns, even negative 3-4% returns, like it was the case for the average at some moments in history. When you have low valuations, investing is easy because your 15-year returns are amazing, 10% of average on a cyclically adjusted price earnings ratio of 10, 11, 12. you get 10% per year, which is a great return. So valuations do matter, and you have to be careful about this. But perhaps the biggest tragedy that lies ahead many investors these days is not understanding what investing is. I recently received this comment that the so-called investor started investing just a few months ago, put the money, all his money into stocks, and hasn't made any money yet. Does he have to change strategy or something? Whoa, so 3 months, haven't made any money yet. With such an attitude, and I see a lot, and we see booming YouTubers, everybody here talking about stocks, free stocks apps, free shares, simply pulls so much money in and people don't know what they are doing, which means they're putting their money into risky stocks, which means that we could see a situation like we have seen in 2002, where after this is okay, this is a good crash, but after 9 years, people were still down 70% that invested in the Nasdaq Composite Index. Now it rebounded, but trust me, 99% of those investing have capitulated by 2009, where you are 9 years into something and you're down 70%. This is what investors don't understand what investing is, that investing is a process that you do over time. You don't just put your money in for 3-4 months and you expect to make money. These guys are likely to be hardest hit and see the hardest tragedy, that put all their money because stocks just go up, stocks just go up, and they don't see the other parts of history, unfortunately, which means there is a lot of risky stocks. But then you think it's just about retail investors. Well, it's not. Also, professional investors that are blaming their retail investors chase those speculative stocks because they live in a comparative environment. If somebody like ARK Investment makes 400% in 5 years, everybody looks bad at all the other investments managers, and there is no risk. Nobody thinks of the risk, and they have to reach those returns, have to chase those returns, which multiplies the whole riskiness of the market, the same as it was the case in 1999, 1998, 2000. This is something we have to think about, because when the trend reverts, it gets ugly, especially on high valuations. And it can lead to tragedies where you don't see any return or a 70% decline after 9 years. That's a tragedy. This means you don't retire when you think you would retire. And trust me, you will sell in panic. You will not hold for 20 years. Also, if we look at the source of earnings, also discussing that riskiness, look at the composition. The weight in the S&P 500 of tech companies is slowly reaching the tech bubble peak, but the earnings per share contribution is a little bit higher, but still not, which is okay, but it's again perhaps a cycle. Top 10 in the S&P 500 are skyrocketing, the FANG stocks, top 5 even more, which puts a lot of risk and concentration in the market. Plus there are many other tech risky stocks that are not in the S&P 500 but heavily in portfolios of many retail investors. And this is perhaps the most significant chart from JP Morgan about investing. The technology sector accounts for 6% of GDP, but is 40% of the S&P 500. Everything is cyclical, everything is competitive, so this is another risk that amplifies the situation. So let me give you 4 strategies that might help you reaching your goal not faster, safer, and that you are sure that you reach it. That's investing for me, reaching your investment goals, not chasing returns like 99% or 95% of the environment is doing. And if you don't want to chase returns, this is the channel to subscribe to. Thank you. And click that like button if you like the video and if you haven't done that yet. Thank you again. So if we look at returns, first strategy is to find good returns that will do well over the long term. If I look at Berkshire, made a few videos, we'll put the links in the description below. And March, of course, 25, it was 10% return, but now we are at 7 as the stock went up. But that's still a good return. No, 7, financial fortress, great outlook, great diversification, Warren Buffett style investing, 7%, you can look globally for better returns. The difference is 7%. 7%, I double my money in 10 years, I quadruple my money in 20 years, I have 8 times my money in 30 years. That's boring. Someone that invested in Tesla has done that in 1 year. Yes, but getting rich slowly and surely and risking, betting to get such returns is a big difference. Getting rich slowly and surely is something you can do forever, over your whole life investment. Betting, I don't know, that beats me. Second thing, second strategy, avoid the risk investments. As Charlie Munger says, avoid AIDS situations in life, avoid doing stupid things, avoid racing the train to the tracks, and you will do well. Similarly in investment, if you want to be sure to reach your goals, avoid stupid things, use your common sense. Also, things constantly change except for value investing. Nobody likes value investing ever, but you see how when you look at relative valuations, again, value is cheap, growth is expensive, same as it was in the case in 1990s. So you can always balance and you can find certain things that will lead you. And then in a crash, growth becomes cheap and value becomes expensive because people always chase the wrong thing at the wrong moment in time. Currently cheap also, perhaps if you look globally, US growth is the most expensive, best returns over the year, but nobody likes, for example, Latin America that supplies a lot of the industrial products that is sold through US growth stocks. So this is investing. Think with your mind. Fourth strategy, subscribe to this channel. We are here so that you help get the right insights that might help you to your financial goals over the very, very long term. Thank you for watching, looking forward to your comments, and I'll see you in the next video.